Good afternoon. Super glad to be with you. It is noon. We are going to get started on our webinar on how to pick apart passive investments. We're going to get started. We're going to be mindful of your time. Certainly appreciate you joining us today. My name is Scott Lurie. I founded F Street almost 15 years ago after getting started in real estate in 2003 with a focus on value add, single family, multifamily acquisition. F Street was started with the idea of creating alternative investments specifically and solely focused in the real estate space. We'll talk a little bit more about that as we get started. For those of you who have had a chance to speak with Mitch, our investor relations, Mitch Ferraro has joined us. He's monitoring the chat. If you have any comments, questions, concerns, or would like to discuss any topic or have any questions about what we're discussing today, pop it in the chat. Mitch will run the question by me. We'll share the question with the group. And we'll certainly get to answer it. If I'm not able to answer it today, I assure you I will follow up with you and make sure we get an answer. So a little bit about F Street and our investment strategy. We are focused on revitalizing communities. We are focused on alternative investments, and we're focused specifically across 3 different platforms in real estate. Those 3 platforms are lending, which we'll discuss, our private debt fund. We have an industrial vertical, which focuses on ground up and value add industrial throughout the greater Midwest region. And then we have a multifamily platform that focuses on value add throughout the country, as well as ground up in southeastern Wisconsin. So passive investments. We talk a lot about passive investments. And what I have realized over the last 20 years and what people have really have validated is that if you are an investor, you are the ones that are creating generational wealth. Going and working or earning a W-2 job or being a partner in a law firm or being a surgeon or being a medical professional, that's all great. And yes, you can become a high net worth individual. Yes, you can become a accredited investor. But to actually become a high net worth or a wealth producing individual, you need to create investments. And we all can attest to the fact that if I'm working 80 hours a week in the surgery center or billing 80 hours a week in my law practice, it's really hard to focus on investing. And so being a passive investor certainly allows you to find alternative investment platforms. F Street's one of them. There are thousands of them throughout the country. And our mission still remains is that be a passive investor, be an investor. You want to make sure you're preserving your assets, you're preserving your wealth, and you're growing your portfolio. So as far as investment goes, passive investments, all of our investors, I'd say 98% of our investors are truly passive investors. They look at real estate, they look at investing as I'm going to take my hard-earned money, I'm going to take my 401k, I'm going to take my self-directed IRA, and I'm going to place that in something where I believe that Wall Street or anyone outside of my control that has not my best interest in mind, I'm going to take control of my future and I'm going to control my passive investments. And so specifically, real estate has been the best conduit or one of the best conduits for the steady long-term growth of passive investments as well as wealth and generational wealth creation. I've seen it personally in my portfolio. I talk to thousands of people every year. And I can't stress enough, and I appreciate you joining us today to discuss how to become better. If you're already an investor and you know everything about passive investments and you're still taking the time to join us today, that means you're still learning. If this is your first foray into investing, welcome. And as well as if you are already investing and interested in what F Street's doing, today is just a comparison on some of the stuff that's out there. We're discussing our own platform and we're discussing expectations for others. So it's an overall discussion on passive investments. And I can tell you this, I'm a passive investor. I invest with other people. I invest a lot in my business, but I also diversify through investments in other people. So it is important. I know that investments and diversification is critical. I've got people that always ask me, Scott, which one should I invest in? And I always respond, invest in everything. If you're going to invest in F Street, I would say invest in all of our platforms because I don't know at which time I'm going to hit the home run in the industrial deal or when I'm going to hit the grand slam in a multifamily deal. But I always encourage everyone to be involved and make sure that you're getting a great passive return and you can sleep at night well. So passive investments, what are they? What are the options in passive investments, right? So we're talking about direct investments. You can go today and be a passive investor in theory and go buy some real estate and have a third party manage it. Well, that might be passive. It truly isn't a passive investment. You actually have to invest time with management. You have to invest time in the business. You have to invest time with all of the other tax returns, with the cash flow, with the management of the bank. There's a lot more that happens when you become a direct investor. But direct investment is buying real estate directly, and that's certainly an option. You can do that through your own cash. You can do that through your 401k, your IRA. You can do that through an LLC. There's many different ways to become a direct investor. There's a lot of debt funds out there. We run a private debt fund. Our private debt fund started in 2009 with a mere $700,000. We just have received, we're just approaching $90 million today. Our goal is $200 million. So our private debt fund's growing. We see a tremendous continued demand for private debt and private hard money, which is our business, the Hard Money Co., which is the consumer-facing side of our business. And the private debt and debt funds are significantly growing, and a great opportunity for passive investments. One of the challenged areas over the world is crowdsourced funding deals. How many of you guys have invested in crowdsourced funding deals? I have. I'm sure you have, or you've looked at them. These are the CrowdStreets, the Realty Moguls. These guys have came out of the gates guns blazing. They were a predominant funding equity source for so many different passive investors. And I wish I could tell you that all of them had great success. They haven't. There's a lot of them that are involved in massive litigation today. They had good intention, but didn't have the right knowledge base to make sure that the investor was protected. And there's massive litigation around crowdsourced funding right now. That world is changing. It's evolving. I think it still has a wonderful place inside of our passive investment community, but be very, very mindful of the countless amounts of litigation that's there. I read an article that there was 3 investments that one of the crowdsources invested in that never actually was a deal. It was a total, complete scam, and all investors lost all of their money. And being a passive investor, the last thing you want to do is place a $500,000 investment into an investment and get back zero. That will materially harm you. That would be a very bad day. You will lose a lot of sleep. And so be mindful of that. And then we talk about this deal right here, equity deals. We're going to talk a lot about this. This is a pretty interesting opportunity where you would come in as an LP or a limited partner inside of a general partnership, where you would provide the equity in exchange for some form of preferred return and some form of equity. And there's so many different structures and waterfalls. There's some that are really simple, F-Streets. There are some that are really complicated, others. Some people do the exact same as us. Some people have waterfall hurdles, and they make it so complicated that by the time you get your money, you're like, whatever happened, I don't know. But being an equity player, being an LP investor is certainly an unbelievable opportunity. You want to make sure you're vetting the jockey. So asking F-Street the tough questions, asking Scott the tough questions. We'll get more into that as well when we get through talking more about equity deals. So keys to consider, key considerations. One is the most important thing is that your goals are in line with what your investment is. Choose your investments that's in line with them. Some people are saying, I want to make a 7% passive return, and I want to sleep really good at night, or I want to make a 4% return. There's double tax-free bonds you can go buy today and get a 4% return. There are risk profiles that you can get a 10% return. Some cash-on-cash returns that are a little bit higher. Some IRRs, right? Internal rate of return goes even higher than that. 17 to 21% is a standard in our industry right now for syndicated deals. We'll discuss that. Risk compatibility. This is one of those points that I really hammer in a lot on. I talk about risk. The last thing you want to do is make an investment with your hard-earned money and be up at night. I wired in money to F-Street, $100,000, and you're up every night wondering, are you going to get your check and is your money safe? If you have that concern, please don't make the investment. I mean that because the quality of life should never go down by the way you make your investment. Your quality of life should go up. You should be creating wealth. You should be creating cash flow. You should be a passive investor, but it shouldn't impact your ability to have a quality of life. And so be very important on the risk compatibility. And then transparency. You have to understand the deal, right? There are so many deals that come across my desk. I look at thousands of deals every single year, and half of them I don't even understand. And I immediately pass to the side. I don't understand how you make money. I don't understand how it works out. I don't understand how I'm going to get my return back. I don't understand if I'm ever getting my money back. And that work doesn't work. At F Street, we're a completely transparent company. If you have any questions, if you ever want to talk to me, myself as the sponsor, or investor relations team, Mitch, or if you want to speak to anybody on our team, it's an open door policy. If you want to come down to Milwaukee, Wisconsin and visit our offices, lunch is always on me. Love to have you come down. So we talk a little bit about direct investments. We're going to talk a little bit about, the pros and cons of everything. Direct investments are capital intensive. You, as the passive investor, would hire in a management company. You will be making all of the cash needs into it. You'll secure all of the debt. And then at that point, you're passing the keys to somebody to manage the asset for you. And they're never going to do as good of a job as you would do on the project, but they'll do a fair enough job, and your rate of return might be a little bit higher, but your passive nature in this direct investment generally is a little bit more than you would think. This will take time of your day. And profit potential is generally a little bit higher. You'll get all of the risk, you get all of the reward. This is certainly something that we have some of our investors that do. I'm a direct investor. I'm also a passive investor in other opportunities that come about. So you can absolutely be involved in a direct investment and be a passive investor in our deals or any deals that are out there. Or you might diversify by saying, I already own 500 apartments. I want to invest in a debt fund where I can just get cash flow. So direct investment is certainly one of those opportunities. So let's talk about the pros and the cons. You control everything, right? You have all the control. You don't have to talk to anybody else. It's you, yourself, and I. You get full upside, right? And you get customization. I want to buy Class A in Beverly Hills, California. Okay, you can do that. I want to buy Class C in Chicago. You can do that. I want to buy industrial in St. Cloud, Minnesota. You can do that. You have all of the control. The cons, as we discussed, not truly passive. Think about this. When you're not really truly passive, how much time are you spending? A lot more than you think. You have all the risk. Your increased risk is there, and you might not be the expert in the industry. So that might be a challenge for you. And then obviously one of the cons is obviously you create liquidity challenges. You are putting all of your money into all of the deal. You are the only one involved. If the property needs more liquidity, or if you needed to put all the money in, your liquidity obviously will continue to go down as you make that investment. So let's talk debt funds. F Street runs a private debt fund. We've ran a private debt fund since 2009. I mirror and I've watched and I see and I evaluate all of the other debt funds throughout the country. Debt funds are, we're not new. We're simply a different jockey than everyone else. But let's talk about the benefits, for example, of a debt fund. You get stabilized income potential. You get a targeted debt fund investment. You can say, I want to make a private debt fund in a leveraged secondary market for businesses. I want to be a primary lender. I want to be a subordinate lender. There's so many debt funds with so many different pieces of the components of debt. You get to kind of discuss that. And traditionally, there's some asset base behind what you're lending, right? So that's always a nice piece of it, that your money is not going into a credit card debt fund, for example, where there's nothing behind it and there's no asset behind it. This is actually traditionally, whether it's a piece of equipment or whether it's a real estate piece or whether it's some form of a business, you have some type of asset. So talk pros and cons. Predictable returns. This is one of the most important reasons why I've been able to grow the fund from $700,000 to $90 million. Our fund pays a predictable return. Here it is, 10%. We pay 1/12 of 10% monthly. So what does that mean? Every month, at the end of the month, I distribute you 1/12 of 10% in your account. You know what you're getting. You give us $100,000, you're getting $833 a month. I can tell you, you're going to get that every month. And we know exactly what you're earning. You know exactly what you're earning. You can describe and understand the predictable nature of that return. Major winner. Lower risk profile. Traditionally, depending on who you pick to be your jockey, whatever debt fund you go with, let's say you went with F Street, I've never missed a payment in 180 some months of payments. We've never missed a payment. We've distributed our returns every single month on the last business day of every month for 184 months. That happens as predictability. And then liquidity is one of the most important things that we ever ask. So a lot of funds, this is one of the biggest discrepancies you'll see in terms of various funds. Some funds lock you up for 3 years, 5 years, 7 years. Our fund locks you up for 12 months. So if you want to have liquidity, 12 months is a pretty low liquidity event. And I'll go one step further. If you need your money back, which has happened to us because someone's made an investment and then a life event has occurred, I've never missed a payment to them, even though they have a 12-month holdup, with no penalty. We've not charged you $1. We've not charged any of our investors $1. That's why they keep coming back. We have a 95% retention rate in our debt fund. Let's talk about the downside. You're capped. No matter how well the fund does, you only earn your 10%. If the fund earns 11%, we're making 1%, you still get 10%. You don't get, when in the years if we make more, you get more. You only get 10%. So if you're happy with just earning 10%, or you're happy earning whatever the debt fund pays out, that's an unbelievable opportunity, but you're capped. You don't have any upside. There is no upside in this program. Inflation vulnerability. Fixed returns may not keep up with inflation, right? If inflation is rising at a rate that has historically, you might not be earning the highest rate of return in the market. So they're not inflationary vulnerable. So you run into a little bit of a risk there should you want to do that. And man, oh man, I have talked to so many people that have been burned by other people doing what I'm doing or other funds. Your due diligence is so important. Your trust level should be low. You should be skittish. You should be asking the tough questions. Give me references. Give me referrals. Show me that you've made payments. Let me talk to your highest paid, your investor. Let me talk to someone who's been with you for 3 years, who's just joined you. Ask those tough questions. I want references and referrals and references and referrals. I want to talk to people that are actually getting your return. Because if they're actually getting a return, they're going to give you the peace of mind. Hey, has XYZ fund ever missed a payment? Have they ever suspended a payment? If they're suspending payments and they're having issues, you're gonna have issues. I promise you. You might not have problematic issues, but you might have suspension of returns, which is cash flow you're looking for from a predictability standpoint. And your due diligence is important. I can't believe, and I mean this in the kindest way to everybody out there in the world, how many people take blind leaps of faith without doing their due diligence to make a $100,000 investment. Do you know how long it takes to make $100,000? And after tax, this is $100,000 of either your retirement or your investment. And most people do zero due diligence. Please do your due diligence. Ask the good questions. Get comfortable. Get on Zoom calls. Come visit offices. Make an investment. Because you know what would happen if you woke up the next day and you lost? What if you invested in Enron? If anyone remembers that company, Enron, the stock was going to the moon. Everyone woke up one day and the world just crashed and Enron's gone. And all of your money is zero? Or if you invested with a Bernie Madoff of the world, God forbid, someone that's just taking money away from you, you don't know. Do your due diligence. I beg, I plead, I encourage. So asset specific versus portfolio. Exploring debt funds are a really interesting piece of it. We're a portfolio-based debt fund versus an asset specific debt fund. So what does that mean? There are debt funds that will write a loan or borrow money or do something. They will take your money and place it somewhere that will be specific to a singular asset. So think about that. Your risk is now diversified across one asset. In a portfolio investment or a portfolio debt fund, which F Street is, you're diversified across all of the portfolio. So currently today in our portfolio, if you invested today, there are 584 loans in our portfolio, equaling the $90 million. If you invested today, you would be part of all 84 versus being part of one. So you're betting that one is good versus 584. So I would much rather, personally, have my risk diversified across 584 loans versus one loan. That's what makes this so powerful. That's what makes a debt fund that's portfolio-based so much more powerful than an asset-specific portfolio-based. So think through that. If you have more questions, let's talk about it. My suggestion, the reason I built my debt fund under a portfolio base is is I used to get calls all the time, and I still do. Hey, I want to know what collateral I'm lending on. Do you really? Do you really want to know? Do you really want to have that collateral instrument? What are you going to do in the event of a default? And if you only get one piece of it, what happens when that one goes bad? Because they do go bad. Let's tell the story, right? When you write loans, they all don't pay back. So you have to go get the money. You have to figure out how to solve the problem, which we're really good at. But from a portfolio standpoint, I always tell people, you want to be involved across my entire portfolio. You don't know more than we know in Mr. Investor or Mrs. Investor. We want to be we want to do the due diligence for you. Let us be your jockey and let us take you to the 10% return promised land. So sector selection, right? Real estate debt funds use a very wide, large selection of funds, right? There's so many different funds. There's a debt fund that's out there right now preparing to go after office buildings. There's debt funds that are going out there for conversions of office building to multifamily. There's multifamily, there's commercial, there's industrial. Know where your money is going and what it is being used for. If you say to yourself, I would never invest in the office market because I'm concerned about the future of the office market, that's a fair concern. Don't then invest in a debt fund that is investing in office buildings. Distressed or not, you're still investing in the office market. So think through what you're trying to get done. Our debt fund is very specific to a fix and flip 1 to 4 family loan. Our average loan is $156,000, our average loan. Think through where you want to place your money and invest in sectors that are intriguing to you. But don't take a blind leap of faith. Other considerations. We talked briefly about this, and we're going to talk about it one more time. Capital lockup. How long do you want your money locked up for? What's the most flexibility you can get? We give the most flexibility of 1 year. We pay 10% and your funds are locked up for 1 year. I've got a 95% retention rate on those funds. That's why I only lock it up for 1 year, because I know that they're going to stay for 2, 3, 5, 7 years. Most people, in fact, have added after the first year. This really is working. We have people that add after the first 3 months. Oh, I get what you actually do what you say you're going to do? Yes, we do exactly what we say we're going to do. Explore the underlying business, right? Explore the business approach. Ask the questions. Talk to the leadership. Figure out what's good or bad. There are people out there that do a great job in the same industry I'm in or in other industries with debt funds. I'm one jockey, and I encourage you to explore all that's out there. I'd love to have your investment, but I want you to be comfortable with what you're doing. Underlying businesses, understand the business. Have the business have any hiccups? Has the operator had any hiccups? What's their past? Have they been successful on their other deals? I can tell you very clearly, my past is squeaky clean. I've been very disciplined in the last 20 years, and I'm very committed to my investors. Our number one focus here at F Street is our investors. Always has been since the day I started with no money and I needed the investor. If I screwed that investor, or if I didn't pay them back, or if I didn't do what I said I was going to do, I don't have the day 2 to have an investor. So day 1 is most important to me. And then payment frequency. When do you want to get paid? Some people pay on a quarterly basis, some pay on an annual basis. We pay monthly. Would you like to have a check monthly? Would you like to have it quarterly? Would you like to have it annually? No one's going to say, I don't want a check every month. And quite honestly, that's why we at F Street distribute funds every month. The best thing I can do is that our investors get their checks every month. They feel good about it. They use the funds for whatever their life's calling for. Think through that. When do you want to have your payment? Ask that question to yourself. So we talked a little bit about F Street's debt fund. I've talked a little bit about it. I also want to just tell you, F Street's debt fund pays a 10% yield. It's secured. It's a real estate-based lending platform that's secured by our entire portfolio. We make investments. We charge a 15% interest rate to our clients, and in exchange, we pay you 10. We keep the yield spread. You also, and I tell you this with great sincerity, you want to invest with a company that's profitable. We are profitable. We make money. You want us to make money so we can pay you. We are profitable. I also talk about steady earnings. I also talk about real estate backed. This is a huge opportunity to make sure you understand. We are a first lien lender. We only lend in the first position. So in the event of a default, we would foreclose and we would take back the property. That does happen. We do take back properties. We do sell the properties. Over the last 5 years, when we take back the properties, we've never lost money. Have I lost money on a given deal? 100%. Have I lost money in the aggregate year? No. So a brief scenario of how it works, a quick explanation. If you invested $120,000 into the F Street Fund for one year holdup, you should expect and you will receive $1,000 every single month at the end of the month. On the last business day of the month, your $1,000 will be deposited into your account every single month. You do get a tax document. Our portal's set up. Compliments to our entire team. Our portal is unbelievable. fstreet.com is designed for the investor. When you put in your information, you will get a tax form at the end of the year. That tax form you should count on is a 1099 INT, which is a reporting mechanism to the IRS. It tells you that we've received interest from us. And you do have, after a 1-year minimum investment, you do have a 90-day two-way call provision. So we ask that you provide us with 90 days to call your capital back. And we also have the right to give you your money back in 90 days. Why did this happen? Everyone asked me. Well, I'll tell you. I always thought that there was going to be a point in time when Mr. Billionaire was going to come by and say, I'll give you $1 billion for your debt fund at 5%, and I was going to then repay all the 10% investors. Mr. Billionaire hasn't come by. I still have never returned any money, but somehow I put this in the paperwork, and so it's still there today. Makes for a great story for me to share with you guys, but nonetheless, a 90-day two-way call provision. Fund benefits. F Street has never missed a payment in over 15 plus years. We have tons of demand. We got 27 loan applications in, I think, in the last 3 days. We're continuing to get tons of demand for our funding needs, which is great. We have stability. Investors are looking to avoid long wait times and seek immediate returns. You put your money in today. You get your return starting today. The moment we receive your wire, the funds are immediately earning a return. Very unique. There's not a quarterly catch-up. Right when the day your money gets to F Street, we start earning your return. Mitch will contact you. He will send you a congratulations. He'll say your money is now earning a return. Your money is earning a return. At the end of the month, we're on April 4th. If you put money in tomorrow, on April 30th, you will get a check from us, an ACH for your payment. I promise you it'll happen. And then we deliver results in cash monthly. So you'll see the cash coming to you on a monthly basis. So we can talk briefly about crowdsourced funds. I've used them. I've invested with them. I've used them to raise equity. I've invested with them to be an LP investor. There's a low entry point. Let's start there, right? Most of these deals have a $35,000 minimum to get started. They want everybody and their mother who's an accredited investor. They do require a verification of accreditation, and we'll talk briefly about that, which is we at F Street, as well as all the crowdsourced funds, use what they call a 506C registration with the Securities and Exchange Commission. That means that we advertise on a global spectrum, and that requires you to be verified as an accredited investor with a third party. Our platform lets you seamlessly become a third-party accredited investor, and we pay for that process. All it means is that as an individual, you earn $200,000 a year, or as a family, an aggregate of $300,000 a year, or have a $1 million net tangible net worth. And so they put you through the cycle. It takes 2 minutes. Most people are done in 30 seconds, and they get an accreditation letter back. Crowdsourced fundings, they're basically focused on real estate. Some do some accredited, some have a non-accredited fund. They're all various different target audiences. Some start at $250, some go as low as $35,000. And everything is done through webinars and through the digital platforms. So it's all digitally done. It's pretty convenient. As I said, being an investor and also raising money through it. We raised money for our Oak Creek project, which is 199 units, and it's been a great success. So we have been a great story for them. But be mindful that this has not been just a straight rocket ship of success. There's been tons of challenges there, and I encourage you to do your due diligence. So here they are, right? Let's talk about them. We know everyone probably knows Fundrise. They're out there. Realty Moguls. This is the one that I used. So this is the one I used. It was great. CrowdStreet, Yield Street, Roofstock, Diversified Fund, Pierce Street. The list goes on. If you don't know who they are, check them out. They'll stalk you once you get on their website. Join for free. Use our accreditation letter if you'd like. Needless to say, yield Fundrise, being an investor in Fundrise, I've just been disappointed with the returns. I think we're at negative returns. I'm down probably $8,000 since I've invested with them. I don't know why I'm an investor, but I can't get my money out. I have to wait through the quarterlies. Your money's tied up. It's a very rigorous process. Take a look, explore for yourself. If you ever want to talk about any of these companies, I'm available. Pros and cons, inclusivity, obviously, it's a broad audience. Join in. Their diversification. You can put $35,000 in 10 deals and invest $350,000. You can do it in 3 deals, in for $100,000. They have a lot on their platform. They do vet you depending on who you are. Some levels are more difficult than others. Realty Moguls took a long time to vet F Street to get us on their platform, but we were successful with them. Super user friendly. It's an intuitive online platform. It's intended for everybody. It's for the masses, accredited investors, masses. So go check them out. You absolutely have no control. We call it limited. I don't know why that's even there. There's no control. Once your money's in, you're in. There's no way out. There's no path to getting out. There's no anything. You're in. The project viability and the complexity of it are traditionally really complicated. They structure waterfalls. So you have what they call waterfall hurdles, IRR hurdles. It gets to be incredibly complex. And then most people, once you're already in, the hook is set, you kind of just reeling yourself in and just saying, I'm going to put in the money. And then you're like, well, I pray for the best, right? I'm like, well, hey, wait a second. You just put in $100,000 and you're praying for the best. Let's be mindful that it's $100,000 or $500,000 or $35,000. Like, that's a lot of money. If you want to pray for the best, black or red on roulette, pray for the best. You only got 50% chance. Well, including 0. And then, suboptimal terms. You kind of are part of the group, and you have fees and technology fees and different structures that kind of suck a lot of that out of where you are. But it works. I can tell you that the reason why they're working less is because those suboptimal terms, along with the challenges that they've had in the market, has really brought down where they are today. I still think they're good. I still watch them. I'm still intrigued by them. I'm not telling you it's not a great investment opportunity. I'm just telling you, be very, very mindful. We talked about platform a little bit, but pitfalls, but you've got volume focus. You've got limited transparency. If you have a question, you don't have Mitch to call. You don't have Scott to call. You don't have any of our team to call. You basically have probably a web chat that you can say, hey, I'm number 10644, and I got a question about something, and we'll get back to you in our standard 48 hours. So, be mindful of what you're dealing with when you get on these platforms. Equity deals. These are my favorite, truthfully, from a diversification standpoint. I'm a debt fund guy and an equity guy. I invest as an LP. I'm also a GP, general partner, limited partner, understanding equity deals. If you get into the right equity deals, you will create wealth. You will create generational wealth, and you will also create cash flow. This is a huge opportunity for you. Please follow along. Please ask any questions you might have. Understanding equity deals is the most critically important part of what I describe as planting money trees, which is your investment into equity deals that are going to continue to produce for a lifetime for you. I'm always want to be mindful that we use this calculation before I get into it called an IRR. And this is what they call, the one thing about an IRR to calculate it is time. Okay, so if you're a high net worth individual, accredited investor, are investing $500,000 a year, $300,000 a year, $200,000 a year, $100,000 a year, you, in theory, do not need the money. You want the money to make money for you. And in 5 years, when you're retired, or in 10 years, when you're retired, or in 20 years, when you're retired, you want all of those investments, all those $100,000 seeds you planted, all of those money trees, you want those to all start producing for you more. And so what happens with an IRR calculation, and we all are guilty of it because it's all industry normal, is that IRR says that in some period of time, 5 years or 7 years, you're going to sell an asset. And you know what happens when I sell the asset? You pay tax. So why do you want to pay tax? I don't want to pay tax. I already pay enough tax. I already got a $300,000 a year job. I'm sick and tired of paying tax. So be mindful of what you're actually, get your life in line, get your investments in line with sponsors that are in line with you. So I will tell you, I always want to get you your money back as a priority. I always want you to get your money back as a priority, but I don't always want to sell. I do have an IRR calculation that says I'm going to sell in 3 years, I'm going to sell in 5 years, I'm going to sell in 7 years. But why? This part is really bothersome to me because I don't want someone to sell something in 3 or 5 years and give me a tax problem. My $100,000 is now $200,000. Congratulations, you doubled your money. You got a 2x, a 1x, a 3x, whatever your numbers are. Okay, fine, great. And now you've got a tax problem. 40%, you have to recapture all the depreciation. And $60,000 of it, of the $200,000 you got, is going to pay the government. What? I have people that have come to me all the time and say, hey, I just made this investment 5 years ago. They just sold it because the IRR says it's going to sell. And guess what? I got back, but I had a tax bill of almost equal to my payment amount. Well, sir, what you don't realize is you've been getting a depreciation number every year. Yeah, but that depreciation number has been $8,000. Well, $8,000 times 5 years is $40,000. Now you're saying you got a real problem, but you weren't even thinking about it. So be mindful of it. So let's talk about ownership stake. When you invest in a deal as an LP, you become an owner. You are an equity owner. You will get a K1. If you do not get K1s, if you're not getting ownership, do not invest. Do not invest. If you're not becoming an owner, if you're not part of the 1065, which is the tax return that's a partnership, if you're not part of the partnership, if you're not signing a subscription agreement, do not invest. What are you doing? You're just giving them sub-debt. Do not invest. You might get a 12% return. They're making 80%. Why would you not be part of it? Do not invest. Preferred returns. Okay, this is an important piece of it. If somebody says to you, you're going to get a preferred return, that means the following. If I'm building a building, I'm going to tell you, I'm giving you a preferred return of 5, 6, 7, 8%. Whatever the return is. That return is accruing during the period of construction and stabilization. Okay, construction, stabilization. So while you're accruing it, if you put in $100,000 and you're getting a 7% preferred return, after year 1, I owe you $107,000. After year 2, I owe you $114,000. Your money's still making money while you haven't received it. So after the 7% is paid twice, now you get $14,000 back. First money goes out as a preferred return. A preferred return is higher up in the waterfall and creates a priority. If you're not getting a preferred return, do not invest. Capital appreciation. The investment can increase in value over time. If you are not part of this, you get, zero. You get 0% of the appreciation if you're not an owner. And you also get 0% of the depreciation. Pros and cons. So the nice part, if you do it right, if you are involved as an equity owner earning a preferred return, you get potential for higher returns. You're involved in the deal. If I build a beautiful building and I project that I'm going to get $2 a foot rent and I get $2.20 rent, and the building's doing better and I was able to sell it at a 4.8 cap and I thought it was going to be a 5 cap, you participate. And guess what? Your interests are in line with whose? Mine. The more I make, the more you make. Nobody can come up with a better win-win than when your ownership and your interests are aligned. Potential for higher returns. More control of their investments in the decision-making process. Depending on where you are in the spectrum, you want to be involved, there's a seat at the table. You want to have a discussion, there's a seat at the table. You are investing with the GP. You generally give the GP all of your control, but if you have a conversation, give me a call. I'd love to hear what you have to say. I'm assuming that when you buy the GE stock and you think that you had a bad experience with GE Healthcare, you call the CEO and he tells you, oh, you want to give some feedback, they'll take it. Lost down a rabbit hole. And then let's talk about this. This is the game. This is game number 1, or it could be number 2 or number 1 in investing. It's all about taxes. Who hates paying tax? I can hear you. I can't all hear you, but I can hear you jumping out of your screen saying, I hate paying tax. Everyone hates paying tax. I hate paying tax. High net worth individuals, the government is going to ask you to pay more tax. If you invest, If you own, there's ways around it through depreciation and what we do with every one of our projects, cost segregation. This moves depreciation up, accelerates it. It doesn't give you more, it accelerates it. It makes it faster. You get more losses at the beginning. Great. The cons, yes. So it depends on so the question is, how does F Street handle a deal after a deal exits the tax liability? So it depends on the municipality. On the state level will generally withhold from the LLC, and that'll get repaid from the state. On the federal level, that'll get transferred to your K-1, and you'll be liable for that. So we are not big time sellers of real estate. Real estate creates generational wealth. We do sell real estate, but if you do not create generational wealth, why are you investing? If you're a high net worth individual and you're making an investment, you don't want a tax problem. You want cash flow. When I go and refinance, we own a building free and clear. In 10 years, I go and refinance it. I give you $200,000 tax-free. Tax-free? Tax-free? Why do you not want that? That's the game. We talk cons. There's higher risk. Obviously, you're involved. You are riding the good and the bad in the deal, right? You're involved. There's more risk. There is no liquidity in an LP relationship while the buildings are being built and stabilized. There is no liquidity. Do not expect to have liquidity events during that period of time. If you do potentially need these funds in month 18, please don't make the investment. You will be up at night. You will be unhappy. There is very little liquidity. Do not make these investments as you're making equity investments. They take a long time. You have a very low opportunity for liquidity. Do not invest in equity deals if you're seeking liquidity. And their complexity. These are tough deals. They're complex. They have got series of senior debt and subordinate debt and equity and waterfalls, and it gets complicated, but it's not rocket science. These were created by some Wall Street guys. I'm saying guys because it was created when they was strictly guys running the Wall Street. And if you think about it, this is how the hurdles were created. But think about it like this. It's not rocket science. You will be able to understand it. If I cannot easily explain it to you, or if any sponsor can't easily explain it to you, do not invest. Equity distribution. Understanding the equity splits in the waterfall. Equity percentage. How much do I own? You will know how much you own of a deal by checking out one really cool form. It's called a K-1. If you look at your K-1, on the bottom of it, it says, what do you own? Percentage of ownership. You'll know what you own. I can tell you what you own. That number never should go up and never should go down. If you're going to lose equity because I've already reached a hurdle and now you're out, why? And then prioritization of capital. Capital will be returned before the general partner. So think about this. Where does the waterfall and the cash go? If you find investors or find sponsors, everyone's got a different widget. Our widget at F Street is I will not get $1 of cash flow until you, the investor, have 100% of your money back. Think about that. All I have is one mission in line, to get you your investment back, and then we share the profits. So now you're getting profit as I get profit. My energy is focused solely on you getting your money back. What an unbelievable money tree you just planted. There it is, money tree. Preferred returns. Understanding a preferred return, it's a really simple thing. Traditionally, preferred returns sit in the waterfall right above the obligations on the property, right? Mortgage, taxes, and then the waterfall preferred return. Figure out what the rate is of preferred return. Is it acceptable to you? Evaluate if the preferred return time frame is acceptable for you. In most ground up deals, expect a preferred return to start paying in month 30 to month 36. You've got 12 to 18 months to build and 12 months and 18 months to stabilize. 30 to 36 months is when you should expect money. If someone tells you they're going to build something and start paying you a preferred return in 12 months, ask them how. And then do an analysis. A higher preferred return doesn't automatically mean you're getting a better deal. Some people say, I'm going to pay you a 10% preferred return, but you're going to get less ownership in the deal. Evaluate it. Equity is the one thing you can't Equity is what everyone wants. And people get blinded by a return. I'm going to give you, instead of a 8% preferred return, I'm giving you 10, right? Let's give you 10%. But what are you doing in exchange for that? They're not doing it to be nice guys. They're doing it because what they're going to give you is less equity. Think through that. Ask those tough questions. So considerations for F Street: timeline, market sector, right? Do you want to invest in multifamily? Do you want to invest in industrial? Do you want to invest in storage? Do you want to invest in NFTs? I don't know. There's so many different syndications out there. Intangibles, evaluate the assets, amenities. What makes it better? You know, some people say, I want to be only on waterfront properties. I want to be in only suburban communities. I don't want to be in urban markets today. I only want to be in urban markets where density is X. Think about what you're getting through. Don't pioneer or create crazy thoughts in your mind that never actually materialize. I don't want to be in Florida because Florida's going to disappear in a year. It's going to be underwater in 100 years. I've heard that once. I've heard California never invest in there for other reasons, that it's going to disappear. What's the exit strategy? Think about your exit strategy. This is really, really important. When you say exit strategy, think about it in two ways. Does exit strategy mean you sell the asset? That's what people traditionally think. But what if you said an exit strategy was, I want my money back? What's my exit game? So if I invest $100,000 with you, Scott, what's my exit strategy to get the money back? That's an interesting conversation. And I'm going to tell you that you're going to get your money back in 36 to 50 months. Okay, that's palatable. Do I still own my equity? Of course you do. Okay, does that mean it's a money tree? Yep, here's the money tree. We're going to now dig. We're going to put $100,000 in a money tree, and in 3 to 5 years, I'm going to give you back your money, and your money tree now has leaves on it, and as you shake it, it's going to start producing cash flow. If community involvement's important to you, community support, is there a need, a housing demand? Do you have some other higher level of interest? Great. And then understanding market demand. We use a market study to help determine what our needs are in each individual market. That market study is traditionally available for you as an investor. Read it. Go ahead. About some key metrics. Let's just talk through them. Internal rate of return, we talked about a little bit. We talked about cash on cash. What's my cash on cash return? We talked a little bit about an equity multiplier. You know, this you should see 1.1 to 2.8 times. And then transparency check. Ask some good questions. How transparent are they? Who do you want to invest with? Make that your decision. Okay. So someone asked a question of I have an IRA or some other comp plans that are retirements. We use Entrust or Equity Trust. There's what you call a self-directed IRA. I encourage everyone with an IRA to get a self-directed IRA. You can control what you do with your investment, and most importantly, you can invest in real estate. You can invest with F Street. You can invest in a promissory note fund, a private debt fund. You can invest in any of our deals. Think about it. There's companies out there. Take control of your retirement. Do not let Wall Street control your retirement. You control your retirement. Don't make blind investments. You don't know what you even own. I own a mutual fund with GE and Disney in it. Well, if Bob Iger dies, the stock goes down to whatever. Why do you want to have that as part of your retirement? Someone else's death. You want to have your future controlled by you, what you own with your assets. We've got 10 minutes left. If anyone has any other questions, please drop them in the chat. We're going to talk about a couple of our pipeline deals. We got F Street OCLV MF2. This is our second multifamily deal in Oak Creek, Wisconsin. We talked about some of those numbers. We've got an IRR at 18.8%. We got targeted cash on cash at 10.66 and a projected equity multiplier of 2.7 times after 7 years. Okay. So here's a little bit about how we got to the numbers. These are all of our development costs. I'm happy to share this with you as well. This presentation will be available for you online. Sample investment, once again, if you made an $100,000 investment in this, this follows the cash flow timeline from June until when you would start getting your money back, which is in 7 years. Excuse me, when it would sell in 7 years with a preferred return, occupancy and move-in, 60-40 distributions based on performances once everyone gets paid back. Investment case study. This is one of my favorite developments we worked on. This is in Southport Commerce in Appleton, Wisconsin. We've got almost 1.5 million square feet going up in this area. We'll talk briefly about a case study, but I'll show it to you. Once again, we made an investment. This actually happened, so I can tell you that this happened. If you made a $100,000 investment, you received a 7% preferred return. $100,000, 7% preferred return began starting October 5th when you placed your money in 2020. Completion of the property, I distributed everyone their money back, plus their preferred return, November of 2021. That is 13 months later. Everyone got 100% of their money back. Their $100,000 is back in their pocket. So is the $7,000 of the preferred return. And guess what your $100,000 is getting you every year? $8,400 of additional cash flow forever until the building is sold or until our tenants move out in 15 years. Your $100,000 investment came out of your right pocket. We planted the tree. We paid you back. The leaves have bloomed. And now you get $8,400 a year and you have your $100,000 back and your preferred return. That's a grand slam. So here's the result. As I said, within 13 months, continuous cash flow now of $8,400. That's being distributed out monthly. Every month I make a distribution to each investor equal to 1/12 of $8,400 for $100,000 invested. If you invested $100,000, you own 1.587% of the deal. Check your K1, it's on there. Development pipeline. I've got only a few minutes left. I want to be respectful of your timeline. F Street is actively and aggressively involved in 3 different verticals, as I told you: multifamily, industrial, and our private debt fund. We're raising $2 million in our private debt fund every month. Please consider getting involved. We just closed on West Bend. We just raised $13 million in West Bend, $11.8 million. That closed, it's under construction. We've got this deal happening right now. This is in Oak Creek, Wisconsin. This is phase 2. It's 132 units. Capital raise is starting now. You'll see it on our website in the next week or so. Development cost $39 million. River Point District, we're working with the city of La Crosse right now in La Crosse, Wisconsin to build 164 units. Going to be a great development. We're in pre-development stage there. Brown Deer Garden Style, we just knocked down all of the buildings to get a TIF. Buildings are already knocked down. We're working on our CDs or our construction documents right now so that we can start construction. Construction will start in late summer. We're really excited about this. I've got a project right next to this, right across the street over here, that's already producing cash flow. I can show you exactly how that's produced. It's a winner. Get involved. Janesville Waterfront. We're working on 125 units in Janesville, Wisconsin. Southport Commerce. This is coming. This is going to be Commerce 4, 250,000 feet, building 4. You've got building 1. This is building 3. This is building 4. You've got 1, 2, 3, 4. This is going up next right here. It's going to look just like this, and it's going to be 250,000 feet of industrial building. Who wants in? Me. Get involved. Talk a little bit about F Street. F Street subscription process is so easy. If you visit fstreet.com, you can log in, get an account. It's free. There are no charges. You can get an overview of all of your investments, all of your distributions, all of your distribution statements, all of your subscription agreements, all your tax forms are on our portal. It's unbelievable. It's super efficient and super easy. We always ask you to earn your badge, get your accreditation. This is to verify that you are an accredited investor under the 506C. And once you verify your accreditation, which is a super easy process, it lasts for 5 years and it can be used in F Street's deals or any deals outside of F Street that require a 506C third-party accreditation. You get it for free. We pay for it. Come and do it. Get your badge. So it's almost 1 o'clock. I'm grateful for your time. I appreciate the questions. If there are any questions I didn't answer, please ask them or please connect with Mitch or myself. I will promise to get back to you. We might take 1 or 2 more questions now. Let's hear that question. The question is, if you invest through a self-directed IRA, do you lose the tax benefits? Absolutely not. That's the great part about self-directed. You get all of the tax benefits, but you're not going to earn what might be a 7% year in the stock market or a negative 4% in the year in the market. If we have a massive win and you're getting that $8,400 that we did in Appleton One for the next 10 years and you have all your money back and you can make 3 more investments, you get all of those tax benefits. It's just that you're the director of the IRA, not one of the funds that are charging you fees. So think about it. Additionally, if you get accredited, I'd love to send you one of our great new swag hats. We're bullish on the world. We're bullish on investments. We're bullish on alternative investments, and we're bullish on real estate. We'd love to have you send you one of our hats or some of our additional swag. Please consider just getting accredited if you haven't. If you'd like one of our t-shirts and you're not ready to get accredited, I'll still send you one, so no problem. Love to send you one. Once again, I'm so grateful to have you join me today. I'm coming to you live from Milwaukee, Wisconsin. I want to thank Mitch and our marketing team, Peter, for being part of making this webinar a success. I thank you so much for being part of it. If there's any questions I haven't answered, please reach out to me. It's scott@fstreet.com. Pretty easy to reach me. I'd love to talk to you. Mitch is always available. We are a transparent, hardworking alternative investment firm, and we want to earn your investment. Please consider visiting our website, and let's do some business together. Thank you again for your time, and have a wonderful week. We'll stick around for one more question. Peter just said we got one. Question is about, can you do a 1031 through a deferred comp? Is that the question? Properties. So the answer is, if you do a 1031 in most LP GP syndications, the answer is no. There's usually multiple magnitude of partners that are involved. So the answer is, it's very difficult, and we do not do them. Most people do not do them due to the complexity of them, because as every LP is involved, there's too many LPs involved. What I will tell you is that there are many families that we work with, that we work one-on-one with them for asset planning for real estate. And at that time, we would set up a TIC structure, which is a tenants in common structure, where we would be buying specific assets on behalf of a family or an estate, as well as ourselves as partners to manage it. We secure the debt, you bring the equity, and then when we sell, you would be able to do whatever you want through a TIC, which is that tenants in common agreement that allows for a 1031 at the end of a sale of one of those. All right, guys, signing off from Milwaukee. Once again, grateful for your time. Thank you for listening. If I didn't answer any questions, or you had a question, or you were too shy behind the keyboard, please reach out. I'd love to hear from you. Once again, I'd love to send you a nice bullish hat, maybe a water bottle, something you're interested in that just shows a little bit about our bullishness and the bull, the F Street Bull. Love to hear from you. Thanks again for being part of this. Take care.